Good evening, everyone. Welcome to this recording. Now, today, this evening, this video is a different one. This is a different kind of video today. Why? Because what I want to focus on is less of the charts and more about, risk planning and in the regards of Forex risk planning. So just to give a bit of background of why I feel like this may very well be one of the most important videos on my YouTube channel. And the reason being, when I started trading, when I started learning how to trade, that was in 2018. I enrolled into an academy and I began to go through content around Forex and everything. And some of the classes, like I remember maybe 1 or 2, 3 videos or classes were on risk management. And that was it. So maybe I wasn't a very good student. So I only noticed a bit of content on risk. But I feel like I wish when I started trading, risk was something that was taught or broken down a bit more, because our focus in the beginning was make money. How do we grow accounts? How do compound accounts? How we double accounts, and so on and so forth. But risk was one of those things that you'd ask somebody, so how do you risk? How do you plan your risk? And how much, and someone would tell you, our mentors or a fellow trader would tell you, risk like 1 to 3% of your account at a time. But really, I don't recall a time when I actually sat in a proper class or watched a YouTube video that broke down risk a bit better or in more detail. And that really cost me. Why do I say that? It's because in as much as, we have all these skills that you need to learn as a trader in terms of the strategy, psychology, rarely is there much content on risk? And if it's there, they're not common. So you see more of the make money online than the protect your account kind of videos. So the reason why I'm doing this recording is specifically for that reason, okay? Because I feel like had I focused on this in the beginning of my learning or my journey as a trader, all those blown accounts would have been reduced or even eliminated. So today, what is the focus? The focus is on risk planning. And I just came up with a basic overview, and I've used my Excel to kind of break it down from my layman understanding. Now, I'm not a mathematician, that's not my strength, but I've had some time to just be able to think about this and put it in a very short clip that you guys can actually use for time immemorial, especially when I say you guys, I mean beginner traders or existing traders who have just never discussed this topic in detail. So yes, so today I'm going to try and help you guys understand risk management from a perspective of planning your risk, understanding risk to reward. Okay, now let me give an example. Okay, so let's say for starters, you start out with a trading account of $50,000. Now, guys, this is an amount that you can fix on your own. All of us start at different levels. When I started trading, I started with a $50 account. So I'm just using $50,000 because it's a figure that is in my head. And I'm actually working with that figure right now to give you this example. So technically, we are told that we should risk about 1 to 3% of our account at a time, right? I'm sure you've had that, yeah. What is the industry standard? 1 to 3% at a time. So if you're risking 1 to 3% at a time of your account, let's say you're risking at a minimum 1%, that means you're risking $500, which is 1% of your 50K account. Okay, that's common sense. Now, another common question is, what is a monthly target? How much can I make from my trading? And there are so many figures out there. Many are arbitrary, many are just, very discretionary. You decide what you want as a trader. But what I've seen, especially when you're trading a bigger account, if you start with a smaller account, sometimes it's easy for you to take a bigger risk, because maybe it's money that you can afford to lose. But when you're trading a big account, like a 50K account, you really don't want to risk too much, because also making that money back in the market is hectic. Yeah. So if you're losing more than 3% of your account at a time in a day, then that means recovery can be an uphill task, so then it makes trading very frustrating. And that's basically what makes a lot of traders get out of the market and just stay out. When we say that there are 97% of traders failing within their first year of trading or quit, it's because of risk. It's not because they don't know how to trade. It's majorly risk and trading psychology. Okay, so your mental space and just your statistical space, whereby you have no clue about the numbers that you're targeting to grow your account, okay, in any given period, whether it's daily or monthly. So on the basis of this, on the whole of the general, most of us will look at our starting balance and take a percentage of that and have that as a target for, maybe we want to grow account by 1%, 2%, 10%, 20%, whatever. But for this purpose of this example, I'm going to use 8%. Okay, so not to say that you can't make more than 8% a month. Okay, we're just working with this figure. I know traders out there who flip their accounts in a day or in a month, 100%, or even more than 100%. But I'm a conservative trader personally, and I like to just give conservative figures that can actually be achieved. So with 8%, your target thereby will translate to about $4,000, which, when you look at it vis-a-vis your starting balance or equity, is not bad. If you're making 8% a month on your 50K account, that's not bad. If it's a small account, that's like, what, $40 if it's a $500 account. And somebody with $500, like $40, that's not anything. But if you look at it in the grand scheme of things and compare it vis-a-vis other things out there, look at the stock market, look at investment in real estate. I mean, the returns you can get from Forex are way, way, way higher. So if you're getting 8% consistently, by the end of the year, you're almost doubling your account, which is not bad. Okay. Because which investment out there can you double your investment in a year? I mean, passively or gradually. So that out of the way, we then look at risk to reward. So what is your risk to reward? And I think this is a class that I missed. It may have been there, but I totally missed it. And the way we are introduced to risk to reward is using our position size calculator. So let me go back to my chart and then, key in my position size calculator. So like right about now, I'm looking at this and I'm thinking, GU, tentatively, maybe I'm waiting for a buy. And let's say I want to buy from around here. So let's say we're already buying this trade. My risk to reward is 6.99. Okay, as you can see, it's showing me a 6.99. That's my risk to reward, meaning that I'm trying to grow my account 6 times. Or 6 times vis-a-vis what I'm risking, which is 8 pips. So I'm risking 8 pips so that I can gain 60 pips. So that's a good risk to reward. This is about what? 43% of my account. Yeah. Actually, sorry, not 43%. What am I saying? It's 6 times, 7 times. I'm growing my account 7 times. That's quite something. Now, there's a trader out there who's going to enter the same trade and say, put their risk to reward, they're gunning for like, what, 10 pips. Okay, scalpers. Now, not to say that scalping is not okay, but in this case, they're risking 1:1. So who is actually doing it better? Okay, if I am going to say it's the person who's risking less for more, meaning risking 8 pips for 60 pips, they have a better risk to reward. Why? Because in case this trade reverses, okay, on both these traders, the one who's scalping 10 pips and the one who's scalping or intradaying 60 pips with a target of 60 pips, if both these trades hit stop loss, okay, both traders will lose 8 pips. However, if we look at it on a consistent basis, whereby you consistently have a consistent risk to reward. So let's say this trader here takes maybe takes 5 trades. Out of 5 trades, 3 are profitable, 2 are losses. So in those 2 losses, he'll have have 8 pips, 16 pips. And his gain, if he gains 2 wins, he'll only have gained 20 pips. So he'll only be 2 pips in profit. But the person who has a bigger risk to reward of 6.99, you will find that if they win 3 trades, they're losing, and they lose 2, they're losing 16 pips. Or if they lose 3 trades, they're losing 24 pips. And they're gaining 60 times 3 is 180 pips. So I remember in the beginning, this didn't really make sense to me in the beginning, because I was like, hey, I just want to scalp and make my money. And then the challenge with this was that, especially at the beginning, I was over leveraging my account, because I was like, dang, I want to make more money. Okay. So the best way to improve on your risk to reward, obviously, is to just improve on your entries as a trader. And this comes with practice. But you really, whether or not you're a good trader, beginner trader, you really don't want to be risking more than you're gaining. Okay, so you find in other scenarios, somebody will put, like, let's say 20 pips, and then they're gaining 10 pips. So if they lose 3 trades again, okay, that basically means they've lost 60 pips. And if they win, they're gaining 30 pips. So they're still in drawdown. And this is what I discovered, especially when I started sharing signals in my signals group, is that I have a lot of scalpers who possibly don't understand this to reward, or don't actually, they do understand it, but they don't really understand it. So they don't consider it when they're trading. They just look for 10 pips. So if I give a trade and I say target 1 is 10 pips, target 2 is 20 pips, and my stop loss is 14 pips, they just get into the trade, not really factoring in mind the size of their own account, as well as their risk to reward. Because obviously my risk to reward for my trading and my account is so different from everybody else out there. Okay. But this is something that is very key to keeping you in the game. So let's go back to my spreadsheet here, and I'm just about to wrap up. So when we look at it here, we can see that what I usually suggest for people is put a minimum of 1 to 4 risk to reward. So you're risking $1 to gain $4, meaning you want to grow your account 4 times within that one trade. That's a really good risk to reward. Like, you can, if 1 to 1 is also good, 1 to 1.5 is good, 1 to 2 is also good. But really, if you're doing a minimum of 1 to 4, even if you have multiple losing trades, like if you have 5 trades and 4 out of 5 are losses, you're still going to be in profit at the end of the day. So sometimes people are like, they look at my stats when I'm giving out my stats on my signals group, and I'm like, I have 80% success. Now, even if I have 80% win rate, okay, in terms of the wins that I get as a trader, if my risk to reward is upside down, I'll still be in drawdown. So you'll find that there's some people who take all my trades when I call them out in the signals group, but they're still in drawdown at the end of the month, and then they feel like these trades are not making sense. So what I'm even teaching my advanced students and my beginner students right now is learn to be patient in the market with the trades. So even if I call a signals out there, try and gauge and see how far can this trade go over a long period of time. Where can I put my stop loss so that my risk to reward is actually high? Okay, so that even if I do take a loss, I'm losing very little, but I'm gaining a lot. So not to repeat myself and not to be repetitive, if we look at it here where we're saying we're risking 1 to 3% of your account, because that's what you're risking. That means if with a 50K account, you're risking about $500 to $1,500. Okay, now $1,500 is a lot of money to lose. Recovering from that is not always easy psychologically. Okay, so you don't want to be losing that much. But think about it: if you have, again, you lose 10 trades, you're down 5K. Okay, but 5K is not 3% of your account. Does that make sense? So you're in serious drawdown on your 50K account. Okay, so this is just an example where you lose 10 trades, you're down 5K because you're risking 1% of your account. So I don't know if this is making sense. If you're risking 1% of your account and that's how you're taking it, that's how you're understanding risk in your trading, then it means every trade you're going to be targeting to lose $500. And that means if you lose 10 trades, really 5K down. Okay, and this is not easy to recover from. So let me show you another way that I used to trade in the beginning. Let me show you how I literally used to trade in the beginning. I know my risk is 1%. And then I used to use like an arbitrary stop loss of 30 pips. But let me be honest, very beginning, first 2.5 years of my trading, I'm now 3.5 years. I never used to use stop loss. And I was one of those traders who used to say, I'm not using stop loss. I don't use stop loss. And at the same time, I was with my mentors. Some of them would also say the same thing. So I'd pick up from them. We don't use stop loss. But then I realized that was not really a good way for me to trade because I'm not very good at the mental game in terms of, I was not very good at the mental game in terms of not being attached to my trade. So if I don't have a correct stop in my trade, then I'm in problems. So I would use, eventually I started using 30 pips and having a risk to reward of 1. So I'm risking 30 pips to gain 30 pips. But if my entry is not good, or if I get wicked out, you find that if I get consecutive trades, I'm down 60 pips, maybe on 3 trades. And I'm up, let's say I'm down 90 pips on 3 trades and up 60 pips with a risk to reward of 1:1. Okay, so I'm still in a drawdown of 30 pips. Okay, so even if I was winning most of the trades, 3 out of 5, okay, 70 to 80% wins, I was still losing. This is how majority of traders, especially at the very beginning, trade. And that's why we get frustrated, not because we are not good traders, not because we don't know how we are trading, it's because we are not understanding what risk to use, what risk plan to use. So why I'm saying this class is very important, or this recording is very important, is I want you guys to now begin to be looking at your risk to reward over and above your risk percentage that you're risking. So for example, still on the 50K account, if I am to risk 1% at a minimum of my account, I'm literally looking at dividing, first of all, number one, step one, dividing my 1% by 4 trades, because I know that I'm going to take about 4 to 5 trades. Okay, I'm going to take about 4 to 5 trades. So I'll split my 1% between those 4 to 5 trades. So usually I trade 4 trades in a day. So that would be me risking 0.25% per trade. So you can see 0.25, 0.25, 0.25. These are 4 trades. And what I'm actually risking now per trade is $125. Now, if I lose all these 4 trades consecutively, and what I tell people is if you lose 4 consecutive trades, get out of the market. If you lose 3 consecutive trades, get out of the market. Okay, don't trade again, wait until tomorrow. Okay, excuse me, guys, I'm here with my daughter. If you hear her speaking, yeah, so we're doing this together. Now, but that said, so these are 4 trades. I'm losing 125, 125, 125. So I'm still losing 1% of my account, which is $500 in a particular trading session. So let's say I trade today on Monday and I lose all 4 trades. This is how much I've lost. Now, based on this, if I bring in if I bring in the risk aspect of risk to reward, now somebody else who's using a one-to-one risk is gaining $125 and risking $125, which is still fine. Okay, they're still risking very, very little of their account. And if they gain, they're good to go. Somebody who's risking 1 to 2, okay, is gaining $250, but their standard on that account in terms of the loss, if the trade hits stop loss, is $125. Okay, 1 to 4, $500. Okay, but their risk is still $125 if they lose this trade. 1 to 10, $12.50. Okay. And in this case, let's say you're trading a 50K account, you can comfortably trade with a lot size of one lot size. So that would ideally mean that you're taking a pip loss of 12.5. Okay, so in my trades, guys, most of the time I put a pip count of like most of my stop losses. Like this trade here is 9 pips. This one is 12 pips. So technically that's the range. So if I was to take this trade, my risk is 4. Yeah, 3.94. So this is a good trade. I would definitely, if I take a lot size of 1 on a 50K account, I'm basically making about $12.50 and I'm risking $125. Okay, so that's what I want you guys to begin to notice or understand in case you haven't yet figured it out. Okay, so I just go back finally to the Excel. So what you find, if you're winning 70 out of 80, so if these are 4 trades, if I win 2 of these trades, okay, and I lose, let's say 2 out, let's say my risk is 70, 80. So 3 trades, I win, I lose 1, or I lose 3 trades and I win 1. Okay, and my risk to reward is 4. I lose 3 trades, so I'm down 125 times 3 is and if I do my math, because guys, I like to use my calculator. I'm not excellent at mental math. So that's $375. So I'm losing $375 on 3 trades. But if I take 3 consecutive trades at a risk to reward of 1 to 4, I'm gaining $1,500. So I don't know if you guys are seeing the difference. Okay. So it's very important. Okay. Once you have improved on your trading strategy, you've improved on your entries, and you know you have, start improving on your risk management and your risk planning. Okay. So for example, this is a very, very good risk to reward to be trading with 0.25% per trade, so that you're never in major drawdown. And it doesn't matter what size of account you are in. I mean, if your entries are good, you can still take a big risk to reward and you'll still make money. So guys, that is the purpose of today's video. That's it for today. If you have any questions, or if you want me to expand this a bit better in a different video, I can. Please just put your comment in the comments box. But for now, thank you so much. Let's start planning our trades. Let's start risking planning our risk to rewards as well, vis-a-vis our risk on per trade. Okay. And let's keep it real, guys. Let's make some money. And yeah, see you soon. Bye.